John had one simple question. What would it take to replace his paycheck? Not just for a year, not just for a short break, but forever. With $100,000 saved, he knew leaving it in the bank would barely earn a few $100s in interest. Putting it all in the stock market might grow the balance, but the income would be tiny. He wanted something better, a way to turn his savings into a consistent cash flow he could actually live on. That's what led him to REITs, assets that are by law required to share 90% of their earnings. For John, that meant one thing: reliable income without becoming a landlord. So he started digging. Which REITs were the strongest? Which ones could not only pay him today, but grow his wealth tomorrow? John narrowed it down to 5. Over the next few minutes, we're going to walk through his exact journey, why the bank won't save you, the simple rules he built to pick winners, and then his top 5 choices. And at the very end, we'll see John's number 1 pick, the REIT that could turn his $100,000 into over $12 million, paying him more than $60,000 every single month. Before starting though, let's set the stage first. When John first heard about REITs, he was skeptical. He thought investing meant either buying individual stocks, putting money into an index fund, or locking it away in a 401k. But the more he learned, the more he realized REITs might be exactly what he was looking for. At their core, REITs are companies that own and operate income-generating properties. Things like storage facilities, warehouses, apartment complexes, and even the digital data centers that power the internet. By law, they're required to pay out most of their profits as dividends. For John, that meant he wasn't just hoping the stock goes up, he'd be actually earning real money or quarterly cash flow along the way. So why not just stick with regular stocks? Sure, a company like Apple or Tesla might grow faster, but their dividends are tiny or non-existent. John wants real cash he can live on. What about index funds or ETFs? They're diversified and safe, but their yields hover around 1 or 2%, not enough to change John's life. This is where REITs stand apart. They combine high dividend yields with long-term property growth. John starts to realize he doesn't just want safety, he wants income today and compounding wealth for tomorrow. And for him, REITs strike the perfect balance. They offer steady, predictable dividends backed by real assets while allowing his investment to multiply over decades. That's the light bulb moment. Instead of relying solely on stocks that may or may not pay him or index funds that grow but produce little income, John sees REITs as his bridge to financial freedom. It's the first big shift in his thinking. He's starting to think like an investor. And with $100,000 in hand, he's ready to put his rules to the test that could change his life forever. So right now, the average salary in the U.S. is about $60,000 to $70,000 a year. Most people do what they're told. They put money into a 401k, hope the stock market does well, and trust that Social Security will take care of the rest. But here's the reality. The average monthly Social Security check is just $2,000. That's only $24,000 a year after decades of working. Think about that. 40 plus years at a job, and retirement means scraping by? Rent, groceries, medications, sure, maybe that's covered, but there's nothing left for freedom. No extra travel, no helping family, no cushion for emergencies. That's not wealth. That's survival. And this is exactly what John doesn't want. He doesn't want to spend his life working only to end up with a retirement that feels like a downgrade. He wants more than just enough. Before John puts a single dollar into the market, he decides on one thing. He's not going to gamble. If he's going to trust his $100,000 to a handful of REITs, each one has to earn its place. That's why he builds a simple but strong checklist. First, the dividend yield. John wants his investments to pay him real income, not just paper gains. So every REIT on his list needs to deliver at least a 2.5% yield, enough to generate meaningful cash flow. Second, dividend growth. A high yield today is nice, but John wants his income to grow over time. He looks at the 10-year dividend CAGR, how much the dividend has compounded year after year. This tells him whether or not a REIT is committed to rewarding shareholders long term. Third, share price appreciation. Dividends matter, but so does growth. If a REIT has a history of its share price rising steadily over the past 5 to 10 years, it shows John that he's not just earning cash, his principal is compounding too. Fourth, institutional ownership. John wants to know that the smart money is backing these companies. If over 90% of shares are owned by institutions, it signals strong trust from large investors. Finally, the sector itself. John isn't looking for trendy plays or risky bets. He wants REITs tied to essential sectors, industries that keep running no matter what happens in the economy. That means storage, logistics, and digital infrastructure. This checklist is John's way of avoiding the noise and building discipline. Without it, he'd be guessing. With it, he's focused. And that's the turning point. John started this journey as someone who just wanted his money to feel safe. Now he's thinking like a strategist. He's not chasing hype. He's building a foundation. And with his rules in place, John is ready. It's time to put his $100,000 to work. So let's count down his top 5 REIT picks and see how each one could transform his future over the next 30 years. Kicking off John's list at number 5 is Public Storage with the ticker symbol PSA, one of the most recognizable names in real estate. If you've ever driven down a busy road and seen those rows of orange doors, you've seen their business in action. It may not sound glamorous, but it's brilliantly simple. People always need more space, whether they're moving, downsizing, or just holding on to too much stuff. Storage units are one of those rare businesses that thrive in both good times and bad. For John, that reliability is exactly the point. He knows people may cancel luxuries, but they rarely give up the space where they've stashed their belongings. And the numbers back it up. In the past year, the stock price has dropped 11.86%, reflecting broader market weakness. But zoom out to 5 years, and it's up around 42%. Stretch it out to 10 years, and the total gain is 42.47%, proving it has rewarded long-term investors through multiple cycles. Even better, 81.4% of shares are held by institutions, which tells John that the big players trust its stability. Dividends are another strength. Public Storage currently yields 4.18%, giving John real income from the very first year. Over the last decade, dividends have grown at 7.36% annually. Combine that with an average annual share price appreciation of 4.35%, and Public Storage becomes a slow but steady wealth-building machine. So what would that mean for John's $100,000? Well, after 1 year, his portfolio would grow to $108,530. After 10 years, it would reach $239,868. After 20 years, $668,780. And after 30 years, that same investment would be worth $2,274,866. Out of that, $762,176 would come from capital appreciation, while $1,412,691 would come from reinvested dividends. By year 30, John would be collecting $196,726 every year in dividends. That's $16,394 arriving in his account every single month. For John, that kind of money would completely shift his reality. $16,000 a month means he wouldn't just pay bills comfortably, he'd be free to design his life. No more worrying about job security, no more stress about emergencies, just predictable, growing income. And that's why Public Storage earns its place as number 5 on his list. Steady, simple, and dependable. Great return, great income, no doubt, but for John, it's only the start of his list. At the very end, we'll see John's number 1 pick, the REIT that could turn his $100,000 into over $12 million, paying him more than $60,000 every single month. Next up at number 4 on John's list is Equinix with the ticker symbol EQIX, a REIT that most people don't even think of when they hear the word real estate. But instead of managing apartments or warehouses, Equinix owns something far more futuristic: data centers. These are the massive, fortress-like facilities that keep the internet running. Every time you stream a movie, upload to the cloud, or use AI at work, chances are the data is moving through an Equinix property. That's why John was drawn to it. While traditional real estate cycles up and down, data demand only grows. The stock's performance proves it has staying power. Sure, it's had a rough couple of years, but over the past decade, Equinix stock has soared almost 193%, turning patient investors into millionaires. Nearly every major institution on Wall Street owns a piece of it. In fact, 97.19% of shares are held by institutions, which shows the smart money sees it as a long-term winner. Now, here's where it gets exciting for John. Equinix's dividend yield is currently 2.43%, which may sound small, but the growth has been massive. Over the past 10 years, the dividend has compounded at 13.71% annually. Combine that with an average share price appreciation of 11.94%, and you've got a solid REIT. So what does that mean for John's $100,000? After 1 year, his investment will grow to $114,370. After 10 years, it would reach $389,779. After 20 years, it would climb to $1,587,580. And after 30 years, that single investment would be worth $6,812,446. Out of that total, $5,140,638 would come from capital appreciation, while $1,571,807 would come from reinvested dividends. By year 30, the dividends alone would be paying John $237,407 every year. That's $19,784 every single month. That is bills covered without a second thought. That's waking up knowing travel, family, and freedom are all options. Not someday, but every single month. And for the first time, John wouldn't be trading hours for dollars. His portfolio would be paying him a salary bigger than most jobs ever could. Taking the third spot on John's list is Prologis, with the ticker symbol PLD, the giant of industrial real estate. If you've ever ordered something online, chances are it passed through a Prologis building before reaching your door. The company owns and operates warehouses, logistics centers, and distribution hubs all around the world. In a world that runs on e-commerce and global trade, Prologis is one of the key players keeping everything moving. For John, this is one of the most exciting opportunities. Unlike storage units or even apartments, Prologis is tied directly to the future of shopping, shipping, and supply chains. As companies like Amazon, FedEx, and countless retailers need more space to move products quickly, they often end up leasing from them. Looking at the numbers, Prologis has a strong history of growth. Over the past 5 years, it's been up around 10.08%. And if you look further back, the last 10 years have been nothing short of impressive, with the stock climbing nearly 188.71%. That kind of long-term growth shows why investors keep coming back, and the big players clearly trust it too. About 95.87% of PLD shares are owned by institutions. Dividends make the story even better. Prologis currently yields 3.73%, which is already solid, but it also has grown its dividend by 12.16% every year. Pair that with an average annual share price appreciation of 11.44%, and you've got a very good compounding machine in real estate. So what would John's $100,000 look like here? After 1 year, it would grow to $115,170. After 10 years, it would reach $414,988. After 20 years, $1,765,444, and by year 30, his investment could be worth $7,713,053. Out of that total, $5,497,087 would come from capital appreciation, while $2,115,967 would come from reinvested dividends. By year 30, Prologis would be paying John $305,289 every year in dividends. That's $25,441 into his account every single month. For John, that kind of income would be transformative. In his mid-40s, early 50s, he wouldn't just have more coming in than most families earn in a year, he'd have complete freedom. And by retirement, $25,000 a month means travel whenever he wants. Total peace of mind about bills and the comfort of knowing he'd never run out of money. At number 2 on John's list is CubeSmart, with the ticker symbol Cube, another self-storage company, but this one comes with a twist. While Public Storage is the giant everyone recognizes, CubeSmart has carved out its own niche by focusing on smart management, customer service, and a network of storage facilities across the U.S. It's not as massive as Public Storage, but for John, that's part of the appeal. Smaller players often have more room to grow. And the demand for storage is everywhere. As housing markets tighten and people downsize, more families and businesses turn to affordable storage solutions. CubeSmart is right there, meeting that demand. The numbers prove it. Over the past year, CubeSmart's stock has dropped 18.55% due to the real estate slowdown, but look over 5 years and it's up 31.28%. Stretch it out to 10 years and it's grown 59.14%. And here's another encouraging sign. About 97.19% of its shares are held by institutions. That means the big investors trust it, and John takes comfort in knowing that he's aligned with them. What really grabs John, though, is the income. CubeSmart currently pays a dividend yield of 5.2%, one of the higher payouts in the REIT universe. And those dividends haven't just stayed flat, they've grown at 9.58% annually over the last decade. Combine that with a steady share price appreciation of 7.1% a year, and you've got one of the best income options. So let's put John's $100,000 to work with CubeSmart. After 1 year, it would grow to $112,300. After 10 years, it would reach $337,051. After 20 years, it would be worth $1,309,407. And by year 30, CubeSmart would turn that single investment into $6,081,339. Out of that, $2,603,913 would come from capital appreciation, while $3,377,426 would come from reinvested dividends. By year 30, CubeSmart would be paying John $546,801 every single year in dividends. That's $45,567 in dividend income every single month. And this is where John's life really shifts gears. $45,000 a month means that he could buy that lake house he's always dreamed about, take his family on vacations every year without worrying about the price tag, and set aside money to help his kids and his parents. At this stage, his financial life wouldn't just be stress-free, it would be overflowing with options. Unlike most retirees who wonder whether their money will last, John's biggest problem would be deciding how to enjoy the extra. At this point, John faced a trade-off. CubeSmart was paying him nearly double what Prologis would, but its total value after 30 years was about $1.5 million lower. That raised a big question in his mind. Could he find a REIT that gave him the best of both worlds, massive monthly income and explosive long-term growth? That is when he landed on his top pick, Rexford Industrial Realty with the ticker symbol REXR. Unlike the global scale of Prologis or the national footprint of CubeSmart, Rexford has a razor-sharp focus: industrial properties in Southern California. At first, John wondered if concentrating in one region was too risky, but then he realized that this is exactly what makes Rexford so powerful. Southern California is one of the most supply-constrained markets in the world. Land is scarce, regulations make new development tough, and demand for logistics and industrial space is through the roof thanks to the ports of Los Angeles and Long Beach, two of the busiest shipping hubs in the country. In other words, Rexford controls some of the most valuable industrial real estate anywhere. The numbers back it up. In the past 10 years, Rexford's stock has surged 210.68%, and with 99.67% of its shares held by institutions, the biggest investors in the world clearly see its strength. But where it really shines is the combination of income and growth. Currently, Rexford yields 4.4%, providing John with a strong income immediately. But over the past decade, it has also grown its dividend by 13.45% per year. Pair that with an average annual share price appreciation of nearly 11.9%, and you've got a rare mix of high cash flow and long-term compounding. So what would John's $100,000 look like here? Well, after 1 year, it would grow to $116,250. After 10 years, $463,724. After 20 years, $2,305,297. And after 30 years, that single investment would explode to $12,426,062. Out of that, $7,992,801 would come from capital appreciation, while $4,333,261 would come from reinvested dividends. By year 30, Rexford would be paying John $729,132 a year in dividends. That's $60,761 every single month. And this is where John's journey reaches its peak. $60,000 a month isn't just financial freedom, it's generational wealth. At this stage, John could own multiple homes, travel first class wherever he wanted, invest in businesses, give back through charities, and set up his family for life. He's no longer asking, how do I replace my paycheck? Instead, he's asking, what kind of legacy do I want to leave behind? So not everyone has $100,000 to start with, and that's fine. You can begin with way less. Click the video on the screen to see how John's plan could grow into $7,000 a month, starting with just $20 a week.